The dollar is in danger, and China has the opportunity to hit the dollar so hard that the dollar will stop being the global currency reserve. This is the first time since 1945 that the dollar is truly in danger. So here in this video, let me give you the facts, let me give you the numbers, and you can judge everything by the end of this video. Because China is dumping US Treasury bills and China is dumping US dollars, oversupplying the market with so many dollars that the dollar is losing its value significantly. Now, if you look at the countries that has most of the US dollars, you will quickly see at the top of the list China with around $3.6 trillion of foreign reserve. Most of this reserve are US dollars. The same thing applies to Japan, Switzerland, and the rest of the countries that you see on the list. And that's because countries since 1945 have been accumulating as many dollars as possible, since the more dollars you have, the more you can trade with the rest of the world. And since the US market is the largest market in the world, countries mostly sold in the United States, and when you're selling in the United States, you're actually obtaining dollars. And that's how the rest of the world ended up with so many dollars. Now, if all of these countries suddenly dump their dollars, that will flood the market with so many dollars, and if there won't be enough buyers on the other side, that could significantly devalue the dollar. But having so many dollars is just part of the problem, because the second part of the problem are the treasury bills. At the top of the list, we have Japan that has over $1 trillion of US treasury bills. That is followed with China with $760 billion of US treasury bills, and then we have other countries. In grand total, there are around $8.5 trillion worth of treasury bills that are being held by foreign entities, by foreign governments, by foreign corporations. And a treasury bill is a bill or a debt that the US government has issued, and that was purchased by somebody. And now the US government has to pay the people who actually hold those treasury bills an interest rate for loaning their money to the US government. The fact that the US dollar has been the global currency reserve was a double-edged sword. On one side, it allowed the United States to trade with the rest of the world and be the leader of the global trade. And it allowed the United States to have the soft power that no one else could actually have that kind of power. On the other side, over time, those countries weren't simply sitting around, but they've been developing and buying a lot of US treasury bills and a lot of US dollars. And now they have leverage over the United States. And if they suddenly start dumping their treasury bills, what's going to happen to the demand of the treasury bills? Their demand is going to go down over time. Now, another thing to consider is that United States have been a safe haven for investments. So if you're making so much money and you are investing a big amount of money and you want the super safe investment possible, now historically, that has been gold. But since 1945, the US treasury bills and the US dollar have been considered as good, if not better than gold. Because gold does not pay you interest, but US treasury bills pays you interest. And will the US government ever go bankrupt? Well, absolutely not. And that's why whenever there is turmoil, whenever there is a crisis, whenever there is any kind of uncertainty, everybody suddenly just rushes to the market in order to buy the US treasury bills. And that's why the yields on the treasury bills suddenly start going down. And that was probably the bet that Donald Trump and the White House made. They're like, we're going to cause this massive trade war all across the globe, and everybody is going to panic and they will come and buy US treasury bills. But you know what? The absolute opposite has happened. There was no rush around the world to buy US government bonds, but people started dumping their treasury bills. And a lot of people claim that it was China or Japan or some of those countries who are suffering from this trade deal or the trade war, and they're dumping their treasury bills, which is causing the treasury yields to rise. Now, that has a lot of implication, because if treasury yields suddenly rise in the United States, that will force interest rates to rise. That will force the cost of everything to rise in the United States. And that is what is truly posing the real danger to the United States dollar at this moment. If you compare the US dollar against the euro, it has been devaluing. Just a few months ago at the beginning of the year, a single dollar was as much as a single euro. But right now, a single dollar is equal to almost 1.3 euros. And a weak dollar just signals one thing, that people are selling the dollars and they're buying alternative assets. And this is a very clear signal that maybe the euro can replace the dollar as the global currency reserve. Again, this kind of massive changes never happen overnight. They take years. But when you have such a crisis of magnitude that we have right now, which is reshaping the global world order. At this moment, people should turn to the United States, but they're not turning to the United States. They're turning to alternative currencies, especially the euro, because the European Union showed itself that they're very calm, they can actually negotiate with everybody, and they're very predictable allies. In business and investments, you want to be predictable. I know that in business, sometimes when you are starting your business, you want to be unpredictable so that you can sign a very good deal. But think about it from capital allocation. Imagine you are Jamie Dimon. Imagine you're sitting at the head of some kind of huge investment bank and you have to make a decision. You're allocating a bunch of money, billions of dollars, trillions of dollars. The only way you can do that is when you have a predictable outcome. The only way you can do that when you know the rules and you know how things are working, because you're allocating so much capital. And you cannot possibly do that when things are very unclear and you don't know where things are going. And that's another reason why the markets are crashing and have been crashing for the past 2 to 3 months. So what does a weak dollar means for the economy overall? First of all, imports are becoming much more expensive, because when you're importing anything from any other country, it doesn't matter whether it's China, it's Vietnam, it is the European Union. You have to take your dollars and you have to buy the Mercedes in Germany with euros. So you have to change the dollars into the euros to buy the German car, which means that if the dollar is becoming weaker compared to foreign countries or the foreign currencies, suddenly everything that you import from the rest of the world to the United States is going to rise in prices, which means that prices are about to increase, which means that inflation is coming. And the United States imports trillions of dollars worth of goods. Just last year, the United States imported around $3 trillion worth of goods. So if you're buying a car, a furniture, or maybe you're a developer who builds houses, the cost of those materials are going to rise, which means that a weaker dollar is going to cause massive inflation, at least in the short run, maybe in the long run. So if you want to actually cheaper prices, you want a stronger dollar. But a stronger dollar is also a double-edged sword. On one side, it actually makes the imports much cheaper, but it makes the exports much more expensive. So what exactly do you want? If you want to boost the United States exports, yes, you want a cheaper dollar. But if you want to make it much cheaper for people to buy things in the United States, then you want a much stronger dollar. But what really scares me off is that a combination of a weak dollar and a tariffs are going to literally spike the prices significantly. So we already have like a 10% of baseline tariff, and then 10 to 20 or maybe 100% of reciprocal tariffs. Even if we assume that they will make a deal and there are not going to be any kind of reciprocal tariffs, there are going to be the 10% baseline tariff. Prices are going to increase by 10% guaranteed. Secondly, prices will increase because of a weak dollar. And when prices rise, what do you think the Fed does in those circumstances? What is the final job of the Fed? Is to make sure that prices are stable in the United States. And that means raising the interest rates. We just had interest rates going down. And the latest assumptions compared to the last year were that interest rates are going to go down. But those assumptions were made on the fact that United States is not going to have the trade wars that it's having right now, and the US dollar will keep strengthening. But the entire rules are changing right now that the Fed might be forced to raise the interest rates, which means that everything will rise again. Most people, when they go and buy a new car, do you think they actually have the cash to buy that car? Well, absolutely not. They have to borrow an auto loan. When people buy houses, your mortgages could possibly rise, and etc. Like, you can apply that to everything that you actually buy right now. Secondly, the faith in the dollar because of that could actually diminish. All of those countries that I gave you as an example right now are holding so much US dollars. And if their dollars are becoming much less valuable, their faith in the dollars will become much less valuable. Those people, or $8.5 trillion of treasury bills that are being held by foreign entities, they will start thinking, well, we actually have so many dollars, but our dollars right now can buy less things. So does it make sense, an economic sense or investing sense, to keep our money in the treasury bills, which could actually lead them to start selling their treasury bills and the US dollars, which could lead to a domino effect where the dollar will start massively losing its value over time. This is not going to happen like overnight. There is still a lot of faith in the dollar, and especially the investors. Nobody wants the dollar to actually crash. Everybody is interested in the prosperity and the growth of the United States. Even if you don't like the United States, even if you're China, even if you're Japan, who is now faced to make a bad deal with the United States, even the European Union, you have like trillions of dollars of US Treasury bills. You don't want the dollar to actually crash. So everybody around the world is interested in the stability of the dollar. But on the other side, compare the US dollar to any other investment. If you see a stock that is crushing, what do? You start panicking and you start selling because you want to minimize your losses. That's what any other investor would do. So if this entire situation could lead to a domino effect, it could actually end up disastrously, especially when the United States is picking a huge fight with China, and China has so much leverage over the United States. What exactly China should do? So if United States is going to push China to massively sell off their treasury bills and the US dollars, it could actually end up badly for the United States. And finally, that is certainly going to lead to increase in asset prices. Any moment that you see that inflation is rising, any moment that you see that the dollar is becoming weaker, that will directly impact the asset prices in the market. So house prices, for example, are going to rise because house prices maintain their value, but the dollar suddenly became less valuable. So in numbers, so that house didn't technically become better in any way, but because the dollar became less valuable, that house will become more valuable. And now take the exact same logic and apply it to the stock market. Stocks will certainly going to rise. Now, right now, don't look at the stock market because the stock market is crushing. The stock market is actually seeing some of its worst days. And that's because investors are afraid about what might happen in the future. We're talking about the US stock market, which is the largest market in the world, and the entire world invests in the US stock market. And this uncertainty is pushing some of the investors to sell off their stocks. But overall, when all of this is over and the dollar is much less valuable than it was in the past, it will reflect on the stock market and asset prices will certainly rise. So at the end of the day, like always, we're going to find ourselves in a situation where the rich will get richer because they're investing in the stock market, while the entire middle class and everyone else will get poorer because most people don't invest in the stock market and don't have a lot of stocks. And their wages are not going to rise as much as inflation, which means that with their previous wages or the current wages, they will simply start buying less things. They will be able to buy less things. Since 1945, the United States was increasing its soft power, but the White House right now is treating other countries purely on transactional basis. So if we buy from you X amount of goods, then you have to buy from us an X amount of goods. But that's not how diplomacy actually works. If you want to have influence over another country because you are this big brother, because you're the Uncle Sam, because you have so much economic power, then you will let that country to be dependent on you so that you have influence over that country. So your relationship with those countries should not be purely transactional. But the White House right now is moving to a purely transactional relationship, and that could force other countries to question themselves. Why should we use the US dollar? There is nothing to get out of the United States. Maybe we should use alternative currencies, maybe the euro, maybe the Chinese yuan, maybe the Japanese yen. I don't know, especially when the faith on the dollar has been going down, especially when so many countries are threatening to dump their treasury bills and maybe even the US dollars. We might be at the exact same moment, just like 1971 style moment when Nixon abandoned the gold standard. So if you could teleport yourself back to 1969 or maybe to 1970, what exactly would you do? If you know that Nixon is about to abandon the gold standard, you would think that is going to devalue the dollar and will make asset prices significantly more. So the only way I can profit out of it, or the best ways to profit out of it, is not to hold a lot of dollars, but to hold a lot of valuable, great assets that I know for a fact are going to rise. And that is what exactly rich people right now are doing. Thanks for watching, and I will see you in the next one.